Hi, I'm Ilya Zlotnick, advisor and partner with Vivaldi Capital Management, and welcome to today's discussion on really two timely tax-related topics. One of them is maximizing business enterprise value through the lens of taxation, and then the other one is the impact of a residency change to individuals and business owners from taxation as well. For today's conversation, we have Dean Pearson joining us. Dean is a principal at PBG Financial and heads up their state and local tax group. PBG Financial is a accounting and payroll servicing firm that was founded in the early 1980s and has offices in downtown Chicago and Northbrook. Dean, thanks for joining us today.
Great, thanks for having me.
Yeah, and before we jump into the meat of today's conversation, maybe spend a few moments letting us know how you initially got into accounting and what led you into this specific area of expertise.
Sure, thanks. So yes, as stated, I handle all matters state and local tax for PBG, the firm, and I've always been state and local tax my entire career in a variety of capacities. Some of that included Big Four firms, national firms, every entity type, every business type, every tax type. So what that encompasses is essentially three buckets: income franchise tax, sales and use tax, and credits and incentives. So it's, a career, and that has been, the basis for my career in public accounting.
Great. Thanks for that background.
Sure.
Now, when I think about the topic that we're going to talk about that's first, which is maximizing business enterprise value from the lens of taxation, when I think about maximizing enterprise value and I talk to clients, it's mostly about earnings, quality of earnings, what the market's bearing from a multiples perspective, revenue growth. We think less about taxes. How do you think about that?
Right. So from my perspective as a tax professional, I encounter a lot of clients, typically smaller business clients, that think about enterprise value in much the same way you just described. So they're thinking about their brand, their earnings, and their business operations. And they're not so much thinking about tax decisions on an annual basis that will eventually impact the business valuation. And that they really should be thinking about that from a longer term perspective. Most of our clients, like I said, are small to medium sized businesses, and nobody can work forever. Eventually there's going to be typically a liquidity event. At some point there will be a transaction or a sale. It could be a family member, it could be a third party. But eventually you're going to go through what we call in the industry a tax due diligence. When you have that liquidity event, there's going to be an examination of the books and records and the tax records related to the business. So when you're thinking about enterprise value, it's obviously important to think about earnings and brand and reputation and things of that matter, but you should also think about taxes in the same way. And what I find is that a lot of business clients approach taxes similarly, and they look at fees, they look at the cost of compliance, the complexity of compliance when they're thinking about, okay, where should we file income tax returns? Where should we file sales tax returns? Should we engage, a firm like Avalara to automate our sales and use tax? They'll also look at it through a framework of audit risk and think, well, this is a small dollar number. We don't have large audit risk. The complexity is high. The cost of compliance would be high. And they tend to have that viewpoint. And what happens is the decision, those are really, to my mind, secondary considerations. Because in the future, what'll typically happen, and what I see often, is that you will eventually, most ownership eventually will have some sort of transaction or investment, or like I said, a liquidity event or a sale. And when that time comes, and it comes time to do that tax due diligence, the acquirer is by nature usually almost always larger. The firm that's going to be doing the tax due diligence will be larger. They'll have many people like me in my role. They'll have other tax professionals examining the books and records of that business. And what happens is they will find all of the unfiled tax returns, all of the unpaid taxes, all of the things that were overlooked for cost or complexity or lack of audit risk, and they will aggregate that, and that will ultimately result in a reduction in purchase price. So, and it could result in much more than that. So you could have instances where it's not just a reduction in purchase price, but the acquirer ultimately wants all the unfiled tax returns and taxes and everything else filed. And the cost of cleanup and the cost of compliance at a later date is much greater than the cost of staying current, right? So when I'm talking to clients on an annual basis, I try to remind them of that and try to frame the conversation. And, would you eventually entertain selling the business? Do you eventually envision having some sort of liquidity event? And typically almost all of them do have that in mind, or are open to that at least. And so I try to remind clients that it's important to keep that framework when you're thinking about whether you should file sales and use tax, whether you should file income franchise tax. In all the jurisdictions, you might have some sort of taxable nexus, even if it seems small now, even if the complexity seems high and the cost seems high relative to the cost benefit. In the future, it'll benefit you.
Yeah, maybe share some examples or an example of a situation where the owner might find it overly burdensome or complex to file those sales and use taxes or those franchise taxes, but you can come in and kind of make that easier for them?
Yeah, sure. I mean, that's a great question. So what a lot of people don't understand just generally about multi-state taxation is that some people do to their credit, and some clients do to their credit, and there's been some better knowledge of this in more recent years, but you don't actually need physical presence to have an obligation to file taxes. So you'll get a lot of clients that say, well, this kind of work was transitory, this project was transitory, we're not physically there, we don't have boots on the ground. Do we really have to file these tax returns? Do we really have to pay taxes here? Do we have to do that? And, again, I revert back to the original framework I had just discussed, which is that if you have any kind of transaction in the future, this is going to come out. And this is going to be used as leverage, against you in a negotiation when you try to sell your business. And ultimately, you're going to pay, right? You're going to pay today and it'll be cheaper to pay today and just file the return and stay in compliance everywhere than it will be at a later date dealing with a potential acquirer who says, oh, look, you should have been filing tax returns in California for the last 5 years. There's no statute of limitations for returns that are never filed. You have these outstanding obligations. Before I buy your business, I want an escrow or a holdback, a reduction in purchase price. And then I also want all of this cleaned up through what's commonly referred to in the industry as a VDA, a voluntary disclosure agreement. And what that basically entails is you would go to a state Department of Revenue and say, we're XYZ taxpayer. We haven't filed our tax returns and paid taxes like we should have. We would like an agreement with you to go ahead and file past tax returns and clean this all up. And, what I find is that in the end, when you choose not to stay current and say, well, because we don't have boots on the ground, because we're not physically present there, we're going to pass on filing tax returns in this jurisdiction, whether that's sales and use tax or whether that's income franchise. Later, it ends up costing a lot more because it almost always results in a reduction in purchase price for the business, which reduces the enterprise value. So you end up paying that way, or you end up paying through professional service fees, and you end up paying the taxes anyway through a VDA in order to clean it all up to actually get the transaction to close.
Yeah, and when we talked offline the other day, you mentioned, as an example, you might have a business that's domiciled in Illinois and they're selling in other states, and maybe they're seeing their competitors not tacking on sales and use taxes, so they might think to themselves, why should I? Sure. From at least a competitive perspective, how do you approach those conversations?
You see a lot of that. I mean, you used to see more of it pre-Wayfair. Wayfair is the U.S. Supreme Court holding that essentially said for sales and use tax purposes, you do not need to have a physical presence in a given state. So there's different benchmarks. They typically revolve around number of transactions and sales volume. Maybe 100 to 200 transactions, 100,000 to 200,000 of receipts in a given state in order to have taxable nexus. That doesn't obviate the physical presence standard, which still exists. So you have both. It's a two-prong test, essentially. But, when you encounter taxpayers that feel like they're going to be at a competitive disadvantage, which does often occur, it's less today than it used to be. Mm-hmm. There's not much you can do with regard to that except remind them that the obligation, especially for sales and use tax, doesn't go away. So to the extent that their competitor sells a product without collecting and remitting sales tax, that doesn't mean that the customer who bought the product doesn't owe use tax on that purchased product. So the obligation exists. And, if I'm a customer, especially if I'm a larger customer or a larger business, I really want all of that taken care of. I don't want a bunch of outstanding obligations just hanging out there, right? So, and if I'm a customer, I also don't want to be, and I'm not, normally registered for sales and use tax. I don't want to have to self-remit use tax. I would prefer that my vendor charge the sales tax. So I have no obligation. I've paid all my taxes. So from a dollars and cents short-term perspective, yes, you could say, okay, well, there is a competitive disadvantage. But from a longer-term, larger business compliance perspective, no. I would prefer to pay the taxes and just have everything covered.
Yeah. Well, it goes back to what the way you're framing it is it's all about long-term and maximizing enterprise value. I mean, in the short term, you might make a few extra dollars, but long-term, it's going to end up biting you. Especially it sounds like if you're looking to do some sort of liquidity event.
Correct. And, another thing that occurs, and almost to a T always, most of the transactions that we deal with are structured as deemed asset sales. Mm-hmm. So a lot of questions I get from typically the acquired company, their representatives, their attorneys are around the theme of, well, this is an asset deal, right? This isn't a stock deal. So, why do the income and franchise tax obligations matter here? Or why do the sales and use tax obligations matter here? Because it's an asset deal. And that really is never going to hold water in a nobody's ever going to entertain that and say, oh, well, because it's a deemed asset sale, I don't have to worry about the business that we're acquiring and whether they have, outstanding income franchise tax obligations. That particularly doesn't hold water in a sales use tax framework, because there is a concept of successor's liability for the purchase of assets that has, that essentially the argument of asset versus stock deal has no bearing on. So you can have a purchaser who purchases assets still acquire the obligations of the former business, even in an asset deal for sales and use tax purposes. And there's notification requirements and other things that are involved in doing that, and it's kind of beyond the scope of this conversation. But the takeaway, I guess, is that there is that argument that it's an asset deal doesn't hold or gain any traction in a tax due diligence. They're going to want everything cleaned up, or they're going to want a reduction in purchase price, some sort of escrow, and then there's also almost always an indemnification related to tax matters. So even when you do an escrow or reduction in purchase price, they might want the owner to indemnify them for, future audits, future tax assessments that could come at a later date.
Got it. And I take it that when you take a new client that's a business owner, you're preaching this from the beginning.
Yes. So our client base, if they've been a client of PBG's and myself for some time, then they're already set up in much the way that I'm speaking. If they are a new client, what we find is that it depends, right, on their former practitioners. Some practitioners will have the same mindset as myself. Some won't. People get good advice. People get bad advice. It's a whole range of scenarios that we see.
Yeah, but I assume it's never really too late. So if a business owner comes to you and maybe they've gone years without filing taxes properly, whether it's sales and use taxes or franchise taxes, there's always a remedy.
Yes. And what I would advise is that it's always better to clean up on your own terms. Mm-hmm. Don't, once you lose control in a tax due diligence and in a transaction environment, and you lose control of that, you're going to pay professional fees, and you're going to have to pay typically much larger fees than if you were to be able to do it in your own right as an owner, right? So the fees that PBG charges are not going to be the fees that Deloitte charges. Yeah. And you might end up as the owner paying Deloitte fees for them to go ahead and clean up all the past, tax returns and filings that haven't been filed. And that's going to be a multiple of what it would have been if you would have just had your own practitioner handle it when you became a client.
Got it. Well, The topic is very insightful, as I mentioned earlier. We work with lots of business owners, and when we're having those conversations around selling, we're going to start thinking more and more of these types of topics. From my perspective, it's not something that I've thought about much in the past. Anything else that you think we should cover on this topic before jumping into the next?
No, I mean, I guess, the takeaways are that it's advantageous just to stay current, really, and take a longer term approach to these types of things. And it pays off in the end.
Great. And then the next topic is another very timely topic. We have lots of clients, both individuals and business owners, that are moving to other states. They're maintaining their homes in Illinois. It's where they grew up, it's where they have their businesses, but for various reasons, whether it's weather or taxes or a combination thereof, they're moving to states like Florida, North Carolina, Texas, Arizona, Colorado seem to be kind of the main go-to destinations. But based on our conversations, it seems like there's a lot of misconceptions with the potential tax issues that people face by making those decisions. So curious to hear your perspective on that.
Yeah. This is a real hot topic. The residency changes, particularly post-COVID now, have really started to accelerate. And what you're seeing a lot is a lot of Northeasterners, high net worth Northeasterners, New York, New Jersey, Connecticut, migrating to Florida. And you're seeing a lot of people in Illinois, Chicago suburbs migrating to Florida as well. I'll use Florida as a general example. Like you said, there's a lot of other states, Tennessee, Arizona. There's, different jurisdictions with different complexities and different rules. But for the purposes of this conversation, I'll use Florida as the example. That's the one we get the most often. And one of the misconceptions, there's several, but the general most common misconception we see is that people think that when they move to Florida and change their residency, that they just don't pay income tax anymore. And what they typically find, though, is that most of our high net worth clients are business owners, and most businesses are structured as some sort of flow through entity, whether that's an LLC or a partnership or an S corp. So, to use an example for discussion purposes, let's say you have a law firm, it's a Chicago-based law firm, and you have one of the partners decides, well, I'm going to relocate to Florida, like you said, for weather, taxes, and all the other benefits that could accrue from such a move. They go to Florida, and with the expectation that, well, now I'm not going to pay Illinois income tax. And what they're not thinking, or they're not advised about, or they don't realize, is that anybody that's a business owner with a business that has operations predominantly in Illinois or other states, they're just going to get K-1s from those jurisdictions when the business files its tax returns, and they're going to K-1 match from an individual perspective. So if I take that scenario where you have a Chicago-based law firm, partner moves to Florida, that law partner, even his or her guaranteed payment is going to be apportioned based upon the business operations of the law firm. And if the law firm's clients are predominantly in the Chicago market, that K-1 may have 100% Illinois income. So, the good news is that lawyer's risk of a residency audit is zero, because Illinois really doesn't care, because Illinois is getting all of their income anyway, right? So you're generating a large Illinois K-1P, and you don't have to file anything for Florida, but when it comes tax time, you have to report all of your income to Illinois anyway. And you get a lot of clients that are surprised by that. Some are savvier than others and are fully aware of that. I would say the clients that get immediate benefit from a residency change tend to be in the asset management space. So they're trading on their own account, and they have large capital gain type income, which can be sourced to their state of domicile residency, the same as if you would sell a share of Apple stock. That would be assigned to Illinois. If you were a Florida resident and sold a share of Apple stock, that would be assigned to Florida, and Illinois would tax none of that. The other types of clients that obviously get the immediate benefit are W-2 wage earners. So if you get high W-2 wage earners that move to Florida, their wages are assigned to the jurisdiction where the work is performed. So they will they will be outside of the scope of Illinois income tax. From an audit risk perspective, like I mentioned, that small business owner probably has very little audit risk because they're reporting all of their income or the bulk of their income to the state where the business conducts operations. The W-2 wage earner and the person that generates income through capital gains might be a different story, right? So, from an Illinois Department of Revenue perspective, they've lost all that revenue just basically immediately from the residency change, which dovetails into, the second part of the misconceptions that we see, which relate to whether a client even changed residency or not. So a lot of times when I deal with clients in residency matters, some clients will communicate with us prior to making these decisions, and we can work with them and set up a plan and give them like best practices of what it would take to actually relocate and change their tax residency. But a lot of times that doesn't happen. And what I get often is clients that go ahead, they go down to Florida, maybe they have a second home in Florida, they change their driver's license, and they, take some advice from some neighbors, from some people that are coming from other states, from New York or New Jersey or wherever else, and then they start counting their days. And they tell me, they'll call me and we'll have a discussion, they tell me all about their days counts, and that they changed their driver's license.
That's the one I hear about the most.
Yes, and now they're Florida residents because they spend the bulk of their time in Florida. And this is from the perspective of myself. I'm an Illinois practitioner. I practice multi-state in every jurisdiction, but we're here, and the bulk of the client base is Illinois. And what I hear a lot are about days counts and how they count and track their calendars. And there's a misconception that Illinois uses a days count. Illinois does not use a days count for purposes of residency. A days count is a great fact. If you spend more time in Florida than you do in Illinois, obviously that's good, and the reverse would not be good. But that is not going to be determinative of whether you're a tax resident of Illinois or not. And I've never met a client that's been able to tell me what the Illinois rule basically is on residency. And a lot of that misconception comes from the fact that New York does have like a bright line days count. So there's a lot of New Yorkers in Florida, and that, people are thinking, well, that's the rule. You have to count your days. But that does not hold true for Illinois residents. The rule for Illinois is that you have to abandon Illinois domicile with no intention of returning and establish new domicile somewhere else. So the problems we encounter with clients typically relate to snowbirds who meet the second part of that test, right? They've got a Florida residence, but they never sold the house in Illinois.
Yeah.
And they're still back in Illinois. And maybe they spend half the year in Illinois, maybe they spend less than half the year in Illinois. They get picked up for an exam from the Illinois Department of Revenue, which is increasingly aggressive in auditing residency changes, particularly to states with zero income tax. Mm-hmm. And they come to the unfortunate realization that they may very well still be Illinois tax residents by way of never abandoning their Illinois domicile. So just changing your driver's license and having Florida real estate and spending, days in Florida is not going to make you a non-resident of Illinois for tax purposes.
So in those circumstances, when you have a client that says, I want to, I have family here, I have friends here, I want to stay here part of the year, but obviously I want to move to Florida for part of the year as well. What's your advice to them? What kind of changes can they make up front to stay clear of any issues with Illinois, if any? Right.
I mean, and it just gets back to the language of the law. You need to abandon your domicile in Illinois. And,
so they have to completely sell.
They don't have to completely sell. And a lot of times you can have two residences in both states. Yeah. And it will complicate the fact pattern. I mean, so that's something I make clear with clients. It is the cleanest way would be to sell the Illinois real estate. Mm-hmm. You can always lease something, you can always rent something. And typically what happens in an exam situation, and I would say, the chance of an exam for a high net worth client that leaves Illinois for a zero tax state is relatively high. is there's a comparison between the two residences in terms of fair market value, square footage, right? And then there's a lot of other subjective elements that come into the test. Does the client have school-age children? Where does the spouse live? Where do the children live? Where do they go to school? Where's the business that generates their household income? Where are doctors and dentists, clubs and religious organizations, things of that nature? So you get into the whole, all the subjective elements. But in terms of residences, it typically comes down to, as I mentioned, there's a comparison of square footage, fair market value, and essentially where the client is spending their time. It's this gets back to the days count. It's not that days aren't important and time spent isn't important.
It's not that clear of a line.
It's not a bright line, right? It's not I'm out because I spent this many days in Florida. That doesn't work that way.
Yeah, it's interesting because there's so many headlines right now in Illinois losing big taxpayers.
Sure.
Ken Griffin recently left, and you have corporations that are leaving. It's hard for me to believe that Illinois will not continue to step up their efforts to stop kind of what they deem to be people that are still residents of Illinois but paying or not paying taxes, or being residents of states where they don't have to pay taxes.
Absolutely, and it's surprising too, just kind of how it works. And I get a lot of clients that say, "Well, my neighbor did this and nothing happened, and everything was fine." And I remind these clients, well, I don't know how your neighbor earns their income, but to get back to my example that I provided with, the law firm and the attorney and the partner in the law firm that moves to Florida, your neighbor might be reporting all of their income to Illinois, even though they're claiming Florida residency. So yes, they've not been examined by Department of Revenue. Why would Department of Revenue examine them when they report all their income to Illinois anyway? It doesn't really matter where they're a resident of, because the business is still generating all its income in Illinois, and they're getting a large Illinois K-1P. They're reporting that. You're different. You get all your income from capital gains. So when you leave for Florida, Illinois gets nothing. So your incidence of audit or audit risk is much higher than that, that your neighbor.
Yeah. I feel like this trend's going to continue. People will continue to move or be snowbirds. So it sounds like with proper planning and proper conversation, that there's ways around it. That's my big takeaway.
Yeah, you should really talk to a professional service provider, whether that be an attorney or a CPA that has background in these types of matters, and think about it as something that could occur well in advance. The other thing I'll mention too is that the topic also has interrelates to what we were talking about enterprise value, transactions, and sales, because another surprise that I have clients realize a lot is that they'll change residency to Florida before a transaction, before a sale of their business, thinking that the capital gain will avoid state taxation, Illinois taxation. And what they end up realizing is that these deals are almost never stock deals. They're always asset deals. And the gain will be realized at the business, which is almost always a flow-through entity. And that capital gain is not going to be assigned to Florida. It's going to be assigned to whatever jurisdictions the business does business in. So even though you changed your residency to Florida and you sold your interest in the law firm sold and you sold your law firm, the gain will be at the partnership, level, the law firm level, and the gain's going to be assigned to all the jurisdictions the law firm does business in. If the law firm only does business in Illinois, the gain is going to be subject to 100% tax in Illinois, and the residency change to Florida avoided nothing. I should caveat, there are planning opportunities related to a change in residency. Typically, there's planning opportunities related to reorganizations that can occur that can avoid some state taxation. But that's somewhat beyond the scope of this conversation. But for the most part, the sale of a business and the change of residency, the tax obligation will be dictated by the operations and the business activities of the business itself.
Yeah. I take it with that kind of planning up front, there's probably some kind of safe harbor provision, meaning that you really have to spend a fair amount of time up front, maybe years, doing that type of restructuring potentially, or
No, I mean,
months.
it could be done faster than years.
Okay.
I mean, I would think best practices are to, if you're entertaining something like this, obviously sooner is better. But a lot of times life happens and, an opportunity might present itself and it might be a matter of months. So I would say most common scenario is 6 months or less, where I'm involved and there needs to be some sort of operational changes, residency changes, and things need to happen in a relatively short order.
Yeah. Well, worst case, they pay taxes, but they get to avoid the Chicago winters. Right. Well, I appreciate your time. Is there any other things you want to cover on that specific topic before we jump off?
No, I think that covers it.
Yeah. Well, this was an insightful conversation on both residency changes as well as maximizing enterprise value. Thanks, Dean, for your time.
My pleasure.